Coming to now your favorite, the equity market view. So if you see earnings have been moderating. So if you were to look at the increases that we have seen post-COVID, if you look at the big jumps in earnings in FY 22, 23, 24, there will be some moderation given the some slowdown that we are witnessing in the economy. Growth is pegged lower as compared to what we saw in previous 2 years. If you see the estimates of the government as well, they are pegging the nominal growth at 10.1% on the nominal level, and hence that should lead plus what we had was margin expansion because of the commodity prices decreasing, also leading to margin expansion over the last 2 years, which probably will go off. Lower growth, lower margin expansion will lead to earnings trajectory moderating over next couple of years. One good point that we have seen is the higher valuations that were prevailing in Indian markets generally are trending lower. So if you see, we have come now very close to the long-term average overall. This is as on December. If you were to see, because of the market correction that we've seen in January, it is trading very close to the very long-term average. That's about Sensex. Of course, other indices are expensive, which my colleague will speak about later. But overall, markets correction was warranted and was needed to clear the froth that was in the Indian equity markets. And if you see what majorly drove this decline was major selling from foreign investors, whereas local investors or mutual funds have been on the buying side. So overall, we have seen, although FII activity in December was positive, this month again we have seen a big negative from foreign investors so far, which is leading to the drag in markets and clearing some of the overvaluation that were clearly prevailing in the Indian equity markets. So what has been the trend in equity markets and what is likely to be going forward? If you see the cyclical slowdown that we are seeing in Indian economy per se, is leading to correction of the overvaluation. So we are tapering off from a big base of growth that we saw over last 2 years, and it's been a cyclical slowdown. We are not still worried about saying that it's a structural slowdown. It's more cyclical in nature is what we think, coming off a high base. There will be some moderation in growth. As I said, Indian equity markets, the recent decline that we've seen was not only expected by us, but also very much warranted given the slowdown in growth and the overvaluation that were prevailing on a historical relative basis as compared to our own valuation or the peer group valuation that prevails, that was compared across emerging markets. We were the most expensive market out there. And we reckon that budget can only do so much. We wish they could have done much to address the rural stress that prevails since post-COVID, which has not been addressed so far by doing things like Manrega, etc., by giving jobs to people which pay them at least a basic income, seems to be missing from the budget. As we see, economic activity has tapered off a bit. Growth pegged at 10.1% is more realistic, and post next year should start recovering, and markets will take semblance of that recovery, ensuing recovery that we may see over subsequent years, somewhere post some correction and when market valuations become more reasonable. We think that investors should make use of this corrective phase in markets to calibrate their allocations. So it could be that, markets may correct a bit further, and investors will make good to use this correction because market valuations have come to reasonable levels, and any further decline will pose as an opportunity to buy into. And hence, one should use this correction because we don't see any structural damage to the India growth story. We should continue to grow at 6.5% real GDP growth rate for next many years, 5-10 years. So any correction should bring expectations to more realistic level, and hence an opportunity for investors to buy for the future growth that we may see in Indian markets.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.